So we're gonna be talking about today. You guys can see my screen, I'm assuming. What we're gonna be talking about today is we're calling it the elephant in the room. We're gonna be talking about all kinds of marketing issues. We're gonna be talking about specifically what we do as we get into the whole recession thing that's coming. And as an added, bonus, a little surprise and delight for you folks, I've gone ahead and added a completely random transition between every slide just to give this all a little extra pizzazz as we go through it. I like that one. Look at that. Agenda. So we've got an hour together, and so what I'm going to be doing with that time, just do like a really brief introduction. I'm going to spend about 30 minutes in the meat of this thing, talking about what is the elephant in the room. We're going to go through some key concepts. We're going to talk about specifically when a recession hits, what exactly happens to sales and marketing, and then how can we best kind of manage for that successes. How do we manage for success when the economic conditions are just poor? There is success to be had, and there are actually a lot of really easy things that we can do to get there. I've set aside about 20 minutes for Q&A, and then we'll kind of wrap it up. Hopefully that sounds good. I can't see or hear you, so I'm going to assume that I have your consent to move forward. Go ahead and pop any questions or notes into the Q&A, and I'll be watching for those as we kind of go through stuff. So for those of you that don't know me, I know that there are people in here who know me. I know I've got some clients in the room, and I know that I've got some folks that I know through LinkedIn and other sorts of means. But my name is Eric Wolf. I'm the founder and CEO of Astound. We're a marketing agency, and we've been doing this since 2006. We've won awards. We've got clients in a bunch of different industries: B2B, professional services, IT, consulting, e-commerce, consumer goods, construction, manufacturing, more. And some of those clients have actually been with us not only through COVID-19, but also through the Great Recession. We've got clients who actually went ahead and did both of those things with us, and we appreciate them very much. But we've got a lot of experience in dealing with these economic conditions, and I'm going to be able to give you guys a lot of perspective on how we have seen folks successfully navigate through those kinds of events. I'm also a co-author of the Unified Marketing System. This is the process that we use to build success for businesses, and this presentation is not in any way specifically about the Unified Marketing System. We call it UMS for short, but it's going to come up in conversation a couple of times, and it does actually address a lot of the problems that tend to come up in these types of circumstances. And for those of you that don't have copies of the book and want them, and we'll talk about that at the end, and I'll hit on that briefly as we go forward. So let's move on. So let's talk about what exactly the elephant in the room is. Let's see what that. Let's talk about how we're going to kind of define that as we go forward. And this is going to be kind of the unhappy part of the presentation. So here's the elephant, and the elephant is kind of causing us a lot of problems, and we're just going to hit it head on. Number one, for a lot of folks, marketing is a constant source of disappointment, and we don't really understand the mechanism by which marketing produces measurable ROI. And frankly, in that kind of environment, if the recession hits, how do we trust marketing to deliver? And then if the recession hits and we're concerned that marketing isn't going to deliver, I guess the best thing to do is start cutting back on the spending. Let's cut back on marketing. Let's cut back on sales. Why do we need sales if we're not making any money? And let's cut our losses and kind of put every and bank a little bit of cash. So we're going to talk about those things head on. We're going to talk about we are actually going to address the elephant in the room, and we're going to start with like the big thing straight up front, and that's the fact that this quote really speaks for itself. 80% of CEOs don't trust or are unimpressed with their chief marketing officers, the person that is ostensibly in charge of producing marketing and marketing results. And by comparison, they really like the other people on their management team. And the problem actually goes both ways. 4 out of 5 CEOs are uncomfortable with the people running their marketing. 3/4 of the marketers believe that that they're not given ample opportunity to actually impact the business in the way that they want to. And so we've got a situation where we've got folks that are very much frustrated with each other. The leadership is absolutely frustrated. They feel that time and money has been wasted on results that are difficult to measure. I just spent $20,000 on this trade show. What was the ROI on that? Tell me what the ROI was on that so I can tell you if we're going to do it next year. There isn't a widely agreed upon process to do marketing. We don't have the equivalent of generally accepted accounting practices. Even in other other realms like technology, we've got best practices, and in marketing, there isn't a process or a set of practices that everybody agrees to that describe how to move forward. And the mechanisms for how marketing works kind of creates a black box around the marketing work, and we don't like that. My opinion is that if a company leader just doesn't understand why marketing is valuable or what they're supposed to be doing, I think that that's marketing's fault, not that executive's fault. I think that that's something that we need to address. The sales team, oh boy, they're frustrated too. There's in many organizations a lot of butting heads between sales and marketing, because they both believe that when it comes to being revenue generators, that they should both be driving the bus. In marketing, we're the architects, and the sales guys, they're the construction folks doing kind of the dirty work at the end of the process. Sales tends to think that they're sort of the rock stars and marketing is the roadies. Hey, get me my pamphlets, get me my landing page. I need this. What does sales want in all of this? Sales wants more leads. When marketing work doesn't directly drive the lead generation, salespeople tend to see it as a very personal kind of betrayal. We have this argument over and over again in cross-functional meetings. Sales says marketing needs to get more leads. Marketing says, look at all the leads we just got you. Why haven't you closed them? The salespeople says, well, those weren't good leads. These are unwinnable arguments, and we absolutely need to stop having them. These concerns are valid, and I think that we all understand why salespeople tend to take it personally when marketing is, when they have beef with marketing. Marketing is frustrated as well. We feel that as marketers, it's typical to feel that we're kept from the tools and techniques that make us most successful. We feel that in a lot of organizations, when things are going well and we're growing and revenue is coming in, sales gets the pat on the back, and whereas when things are going poorly, we get the failures. There is a lot of issue with that, and it absolutely frustrates a lot of people in marketing. We also have the thing where it feels like goalposts are moving, and leadership never seems happy. And what comes from that, the ultimate result is this atmosphere where the only thing that we can think of to get us out of this constant frustration is this idea of the magical thinking that, okay, let's just get this done, and then things are going to be better. And if we could just get that CRM, or if we just get HubSpot, man, it's going to be a lot better. And of course, those things never work out. To to folks that are outside of marketing, it feels very much like a black box. And one of the things that I'm going to do over the next 20 minutes is I'm going to be opening that box for you. Oh, I like that one. Uh, uh, I'm digging the random transitions, guys. This is a lot of fun. It's easy to look at marketing and sales as easy places to cut from when times are tough. Why are we going to spend money on the parts of the business that are supposed to generate revenue when we're in a recession and revenue isn't coming? So let's talk about a few kind of key concepts that are going to help us sort of get out of this mess and get everybody back on track, and hopefully break down some of the frustrations that everyone is feeling. Because obviously, when we're all sitting around being angry and frustrated with each other, what we're not doing is creating value for the business. So I'm going to kind of break down a few concepts, and then we're going to dig specifically into the recession stuff. That's fun. So there are two ways that we tend to look at marketing, and there's that in the weeds portion. What did we spend on AdWords this month? Did we add that new page to the website? Who's on the list for the next direct mail campaign? Or then people tell you, well, no, take the airplane view, take that 50,000 foot view, and let's talk about what the brand is, and let's talk about what our values are, and which one of these things are right. Well, at different points in the process, they're both right. We need to be looking at things in both ways, and we need to be doing that on a consistent basis. When we're talking about what we do and how we organize the transition from way, way, way up here to way down in the weeds, we've got 13 questions that we use. These 13 questions are central to the UMS process and how we address things. And basically what we're doing is we're starting way up here, and we are gradually coming down to the surface, right down to the level where we're looking at the numbers, looking at the results, and then deciding what we're going to do next about that. We're not going to go through the 13 questions in detail, but in understanding how we look at problems when we're in them, essentially what we need to do is figure out, where in that scale we are, in that way up view. Is it something really fundamental that we need to figure out, or is it something that's down here in the tactics? And so understanding where the problem is that we're trying to solve is very, very helpful. We talk a lot about the difference between looking in the mirror and looking out the window. When we look in the mirror, we only see ourselves. And when we're looking in the mirror, we tend to be selfish. I don't know a better way or a kinder way to say that, but it's the way, unfortunately, that it's the default setting of how a lot of us tend to look at our businesses. We're looking at ourselves in the mirror, and what we really need to be doing is looking out the window and figuring out, what the people out there need from us. We talk about this concept a lot when we're talking about crafting messages and writing marketing materials and understanding your audience, because a lot of us market to ourselves instead of marketing to the people outside. Within the context of a discussion about the recession, we look in the mirror and we see somebody who's hurting, and we're looking for ways that we can make the pain go away for ourselves. But outside of our window is the audience. Many of the people that we sell to, if we're in a recession and we're suffering through a bad economy, we may be hurting, but the people who are paying our bills, they may be hurting too. How can we best serve them during that time? How can we use this time to connect with them? That's something that I really want people to think about as they're thinking about, well, what are we going to do if the recession hits? Um, okay, that was delightful. I'm just going to say it. This is the sales process. A lot of people talk about sales funnels. Um, if you want to if you want to draw a dirty look for me, talk about this. Talk about your sales funnel. I really think that it's more of a hill, and I understand that we're talking about two things that kind of start big and then get small. The difference is whether it goes this way or this way. The reason it's a hill is because part of the problem with the sales funnel is that funnels, they have gravity. And a sales process, absolutely, if there's one thing that a sales process never has, it's gravity. There is no guarantee that if I throw 100 things into a sales process, that a certain number of them are going to fall out the bottom. That's not what's going on in sales. What we are doing is we are trying to Sherpa somebody up a treacherous path where a lot of them are going to want to turn around and go home. That's what sales and marketing is like. And so we wanted an analogy that better describes that. Down here at the bottom of the hill, this is kind of where the marketplace is. This is the divide between where we are and where the market is, and it's our first and primary job as marketers to bridge that gap. The second thing that needs to happen is that people need to obviously understand that we're here and that we can solve your problem, and so that's awareness. Out here it's like I have a problem. Over here, it's this is a company that can potentially help me solve it. The biggest fall off between any point in this hill is going to be the people who hear about you versus the people who actually connect with you in some meaningful way. Whether that's talking to you after a conference, whether that's following you on Facebook, whether that's signing up for your email list or talking to your sales folks. That's our biggest and kind of steepest gap once people know of us. Beyond that, there are opportunities, make a sale, and up at the top of the hill, our job changes. We're no longer trying to get you to the top of the hill, we're trying to keep you there. The difference, and this is the fundamental thing, but between in the idea of having a unified marketing system and breaking down the frustrations, the sales and marketing process is the exact same process. We just handle different parts of it. Out here, we're talking to a lot of people. Marketing strength is essentially a one-to-many relationship. We are really good in marketing at building and managing these one-to-many types of relationships. We're good at talking to an audience. Give me a microphone, give me a room full of people, and I'm going to do a really good job. What sales is really good at is the one-to-one relationships. And so somewhere around here, right between when something becomes an opportunity and when we're actually trying to make that sale, somewhere in here, essentially it stops being a one-to-many relationship and it starts being a one-to-one relationship. And that's where sales comes in. In order to have a really functional sales and marketing foundation is understanding that relationship and understanding that it's not a different process when somebody gets here. It's just a continuation. And one of the reasons that they got here is because of all of the stuff that happened between here and here. None of us get to do it all on our own. Marketing, unless you're talking about a purely e-commerce kind of play, that's the only occasion where marketing does this entire thing. We need sales to take that last part of the climb where marketing tactics become less effective, when that relationship needs to become more personal. What we do at the base level, what's inside the black box really is a machine that makes lifetime value go up and the cost of customer acquisition go down. That's what marketing is really doing. When you're trying to measure the impact of marketing in your business, it's not about web traffic. It's not about how many leads were generated. Um, uh, it's not about what the creative looks like and who wrote the blog post. Those are all basically byproducts of what this machine does. And when marketing is successful, when you're saying, well, what role does marketing play in my business? Well, the role that marketing is supposed to be playing, and the role that marketing is going to play when we really look at it, is we're going to increase that lifetime value of the customer. Essentially create better relationships, make those relationships last longer, make them more profitable, and we're going to try to drive down the cost of acquiring new customers. That's what marketing does. And then I'm going to explain, I think this is the last topic that we're going to hit before we go and shift focus to really dive into all of the stuff that happens when we're in that recession mode. But basically, when you take those two numbers, the lifetime value of a customer, and usually we measure that based on the gross margin of what a customer is going to give us over time. So if I have a product, my gross margin is 30%. I have, let's say I have a subscription. They buy from me every month, and so how many months is that average lifetime going to be? How long does the average customer stay with me? I put all those things together and I get the lifetime value. Of course, lifetime value isn't just for subscription-based businesses or recurring revenue-based businesses. You can do this for anything from, a coffee shop all the way to a high-end consulting firm. So, but when you take those numbers and you take the lifetime value and you divide it by the cost of acquisition, you get a ratio. And what that ratio tells you essentially is how much of your gross profits you're putting back into growing the business. Companies that are marketing oriented, companies that are oriented for growth, if you take the lifetime value and the cost of acquisition, you're going to end up with a ratio somewhere in here. If the ratio is low, we're down in this 2-to-1, 1-to-1. If the lifetime value and the cost of acquisition and what we're paying for cost of acquisition are the same, essentially that means that we're willing to operate at a really steep loss. What kinds of companies do that? Silicon Valley venture funded startups. Those are businesses that are designed to lose money and lose it quickly for a period of time to get that customer base as big as possible. That's what that looks like here. On the other extreme, where the ratios are high, well, that means that we're really not investing much of anything into our growth. If we're not taking that lifetime value and turning that into a cost of acquisition that's going to help us scale. Out here, these are sort of lifestyle businesses. These are businesses that are keeping as much of the profit as possible, which is, of course, also a valid business. But if we're looking at growth and we're looking at being a marketing driven company where we are, growing in a controlled way and in an aggressive way, we're trying to be somewhere around here. And this is going to be really, really important when we get into the recession part of the conversation in just a minute. So what happens to sales and marketing in a recession? That's a good question. I'm so glad I asked it. So here are the things that specifically that are going to happen when the economy gets bad. So number one, We're going to basically use every euphemism that we have for cutting money, very often in places that we know that we shouldn't, but we feel that we have to because we're afraid of slipping under the tide. Um, on the flip side, so look in the mirror. Now let's look out the window. We've got customers who, at the same time, are also doing those same things because they're concerned about overspending. The cost of advertising is going to go down. This happens in digital marketplaces because, essentially like a Google AdWords type of scenario is going to be essentially it's a demand driven market. Things get bid up and bid down. It's very much like a stock market or commodities exchange. And so as people cut their budgets, demand for advertising in most all of our industries are going to go down. And so that means that the price of doing the advertising goes down. This happens in traditional media too. But unlike, where uh, on say Google AdWords or a lot of pay-per-click types of advertising where the price fluctuations are sort of built into the model. In traditional media, where we're negotiating things like TV buys or billboards or any of those um, kind of typical things, we're going to get price breaks by way of, just negotiating like, hey, you guys have more inventory than you used to, you know, pass on some of those savings to me. I'm going to stick with you through this recession. I'd like to pay less, or I'd like this value added piece, whatever I can get to keep me an advertiser. Folks are usually willing to do that. So the price of advertising goes down. This is one of the good things that happens. Um, the other good thing that happens in an economy, in a down economy, when we're talking about our marketing folks and what we do, we tend to refocus on basics. It's a really good excuse to get rid of the stuff that's trendy or the stuff that we were just kind of dipping our toe in. Let's buckle down and let's do the tried and true stuff that we know works and all of that. We were going to do an experiment on Snapchat or TikTok. Now's not the time. Let's get back to the blocking and tackling and make sure that we're doing that right. I put an asterisk on this, and what the asterisk is, that we're talking about typical recession circumstances. I am not an economist. Please do not confuse me as such. I'm just a guy that has been doing marketing for close to a quarter century. I know how it works. But one thing that people are saying as we approach this recession is that folks are saying that people aren't cutting their spending the way that they used to. They're or the way that we would expect them to. A lot of people are saying that as the economy slows down, demand is staying fairly steady. And so, is that a thing that I can explain? It is not. Is that a thing that may or may not continue? I have no idea. I would think that eventually this would start looking like a traditional recession, and that we're going to see people really tightening the belts. But we've seen a lot of weird stuff in the last 2-3 years, since really since COVID, and things don't happen always the way we think they will. So let's file that away. But we're gonna talk about what happens in a traditional recession and how we deal with that. When it comes to the numbers that really matter in terms of what is, that we're using as to indicate the health of our marketing, they're both going in the wrong direction. It's harder to acquire customers in a bad economy. As we've said, people are spending less money, and so the cost of acquisition, that CAC, that goes up. And again, as people are tightening, and as we're spending, budget tightening on both sides. So what's happening is that people are wanting to spend less money, and of course, we're also spending less money to serve them. And so that tends to cause a reduction in lifetime value. So we've got the things that we're trying to do, and they're both going in the wrong direction. So we're going to acknowledge that, and we're going to talk about that in just a moment. So how do we manage in the recession? How do we take what's going on in the world economically, flip it on its side, and make it work for us as much as possible? I'm going to give you 4 different recommendations, but the thing that I want to make sure that everybody walks away with this from, because it is completely 100% true. As Warren Buffett, who knows a thing or three about making money, has said, bad news is an investor's best friend. It lets you buy a slice of America's future at a markdown price. That's the philosophy that we take to marketing in a recession. Prices are going down, and we have the opportunity to buy low. So our first recommendation in terms of effectively managing marketing in a down economy is, number one, we really have to adjust our expectations. In a down economy, success is going to look different. We're not going to see it in the ways that we're accustomed to. We're used to a world where we increase the sales and marketing budget, and guess what happens? Sales increases. How fantastic. In this case, it's not going to happen that way. We've got to embrace positive outcomes that don't necessarily lead directly to revenue. There are some aspects of this process that are going to be really, really hard to impact during a recession. And so if we go back to our friend the Hill, up here, it's going to be tough to get people up here. But we can work down here in the awareness area. We can get a lot of messages out at a lower price and really sort of build our brand, build our reputation, enhance our standing in the marketplace. Even if we can't impact people's behavior here and get more people up here. The other area that we can work, which will help us, counteract as much as possible that natural lowering of the lifetime value during a recession, we can invest in our current customers. We can invest in retention. That's an area of the Hill that we can do a lot of work on as well. My second recommendation is change the approach to spending. So no matter what we do, we know that those two outcomes are probably going to happen to some extent. Lifetime value is going to go down, CAC is going to go up. Unfortunately, if we cut our budget to the bone, basically we're only going to accelerate that process. It's like it's like if you got a fire in the house, and you've got next to you on this side you got a fire extinguisher, and then on this side you've got a can of gasoline. When you cut the budget way down, essentially what you're doing is you're throwing gasoline on the fire. You're kind of maximizing the damage instead of minimizing it. Just because the house is on fire doesn't mean that the house can't be saved and that the house, is going to even have a whole lot of damage. There's going to be some damage. The idea is to minimize it, not to allow the house to burn down. We don't want to stop shopping. We just want to shop smarter. We know that the cost of advertising is going to go down. And we know that digital media is going to drop faster than traditional, and probably drop lower too. And so what we can do is we can take advantage of that. We can get a lot more bang for our buck doing advertising, basically building up that part of our marketing mix. And the other thing that we can do is we can talk about, we've got these funds that we've been using, specifically towards acquisition based stuff. We're doing, you know, direct mail and things like that, and looking for acquisition um, as a result of that. We can take that money and we can put it into something else, like perhaps digital media, and we're probably going to get better bang for our buck there. Um, the funny thing about the way this ratio works is that, so when we're, if we're out here with our marketing, or maybe even right here in the sweet spot, what when cost of acquisition goes up and lifetime value goes down, what's happening in this ratio is that the ratio is trying to push us deeper into the sweet spot where we're focusing on marketing. The numbers are telling us focus on marketing. This is the natural thing that we need to be doing right now because of how our business basically is interacting with the world. When we slice down the budget, what we're doing is we're kind of artificially pushing ourselves out here. The market is telling us how to fix things. It's telling us focus. And so that's a thing that we really encourage people to do when they're thinking about, especially how they're spending their money during the recession. Recommendation number 3, keep our foot on the gas. Don't stop. If you're thinking about cutting hard and fast into your marketing and sales budgets, guess what your competitors are thinking about? And guess how many of them are actually going to do it? They're going to be suffering the same effects as you are: rising cost of acquisition, lower lifetime value, a lot more difficult to make a sale. Everyone says the economy is terrible, and so cut, 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 cut. Um, if, and I'm not suggesting that we go and triple down and we go all out. I'm not suggesting that we do anything dangerous or reckless as we're doing this. But if our competition hits the brakes, if we're just driving, 55, we're still gonna be way ahead of them at the end of this thing. Keep moving, keep your foot on the gas, do it safely. We're not suggesting that anybody do anything that puts their business in any kind of immediate jeopardy, but keep your foot on the gas and don't forget about the current customers. If we can find ways to retain them during this, we're probably going to be able to retain them long term. A very poignant saying. Now, this version of it comes by way of Jim Butcher, who is a writer, author, novelist. But of course, I think we've all heard versions of this in the past. You don't have to run faster than the bear to get away. You just have to run faster than the other people that are kind of around you. And so we're not trying to outrun the recession. We're not trying to beat the bear, but we have a great opportunity to ensure our long-term success if we just keep running faster than our competitors. And my final recommendation is, if we can find a way to make it through today in good shape, and when we say survive, I mean, intact. We're not on life support. We're not, there are plenty of things that qualify as alive without really qualifying as surviving, but we want to survive now so that we can thrive in the future. If we keep this machine moving, that means that we feel the benefits of recovery sooner. So the economy goes like this, and if our marketing is staying consistent that whole time, we're already there and moving. And as soon as it starts going like this, we get instant benefits. The people that broke down the whole sales and marketing machine, they've got to rebuild from scratch. And so in recovery, you experience the entire thing versus the part where you wait around. It's like, is this really recovery? Are we really okay? Is it gonna? Um, you get the benefit of the whole thing. The investment in advertising pays off long term too, because even though prices will come back up, you're still going to be paying below market rates. You're going to, for that traditional media side, obviously you're building up a lot of goodwill, and that's goodwill that you should expect as a business person to be able to cash in on then when the economy is good. And with the digital media, that long-term savings, again, it's a part of the program. It's part of how it works at its core. Um, because as you advertise and as you advertise consistently, the advertising platforms are getting to know you. This is especially true in Google, but it's true to an extent with all of them. Um, we are we're building up a trust factor, and advertising digital media companies provide programmatically better rates for businesses that they trust, and of course that make their platform look good, because Google, for example, Bing, Facebook, they want to make it as easy as possible for their customers to find reputable businesses to do business with. When somebody clicks a Google ad and has a really terrible experience, or people click an Instagram ad and have a really terrible experience, that ultimately ends up getting felt by the platform as well, and they don't want that. And so programmatically, you're going to end up keeping your lower prices far longer than your competitors will. And essentially, this is steroids for your future marketing efforts. Sam Walton said, control your expenses better than your competition. This is where you're going to find the competitive advantage. And I think that a lot of people are going to say, well, it's talking about being cheap. We know how Walmart deals with their vendors and things like that, but he doesn't say cut your expenses. He says control your expenses. And so if you control your expenses through the recession, you're going to find the competitive advantage. Cutting quickly and indiscriminately is not control. That's a free fall. That's that thing where you're that moment of being in the plane and crashing and landing kind of can feel the same. Not that I've ever been in a plane crash, and I hope that none of you have, but it's that control. That's the difference. And so that's a real learning, and it's something that we've seen really be the difference maker for companies that we've worked with through tough times. And it is now 11:47. I have no idea if I can make it so that people can actually talk, but if you type questions into the Q&A box, I will absolutely answer them. And while you all are typing, hopefully this has been helpful, and I'll go ahead and skip to the end of my bit, but go ahead and type your questions. Anybody here who would like a copy of the book? If you don't have one, I know that some of you do, but if you don't have one, I am happy to send you one if you want one. You can email me directly at eric@astound.com. From the perspective of the unified marketing system, we're doing implementation engagements. We're doing a lot of consulting around that. These are problems that we can solve for folks. So, so if you would like to talk about that, give me a shout. I'm here for that as well. Um, but in the meantime, if you have any questions, go ahead and type them in, and I will be very pleased to answer them. And I am sorry again for my Zoom malfunction. I thought you guys were going to be able to do video and audio, and I kind of screwed that up. I should have um, should have figured that out, but I not assumed. You assume you make an ass of you and me. Mostly this time, just me. But yeah, any questions? Type them in. I'll hang out until 12, and so if anybody has any questions, just give me just drop me a line. Thank you all for coming. I really appreciate it. Hopefully, this is valuable. Okay. Uh, Thank you. Mental health services. What are key differences for working through a recession when your services are tied to such a hot topic where spending and need has never been higher? And this may be one of these cases where where demand doesn't actually drop off. We've seen it. If you think back to to what happened during COVID, now there were a lot of businesses that suffered hard during those first few months of COVID. We were in lockdown, and I hope I'm not um, giving you any PTSD. But just like there were businesses that really suffered hard during those times, traditional brick and mortar retailers and restaurants, for example, certain types of entertainment, professional sports, movies. Um, there were also a lot of businesses that came out of that really, really well. There was a lot of really good stuff that came out of COVID for a lot of businesses. Businesses that did home delivery, businesses that actually, Zoom being a prime example, Grubhub, those types of businesses. There's another example of one of those businesses that is currently present on the webinar right now. But but you may be in a business that doesn't go like this during the recession. People are going to have, if people are suffering, if people start losing their jobs, if people start making less money, you're going to have a lot of people in mental health crises, and so it may be a time that people are going to look at businesses like yours to really take the hero that hero stance of like, hey, things are tough, and we're here to help. Just like a lot of businesses that centered around the home did during COVID. And so I think that it's going to be, I don't have a specific answer for you, but I would say be prepared for people to be, leaning on you guys, more than ever. And if pricing ends up being a um, if pricing ends up being an issue for folks, that's an opportunity for you guys to invest in something uh, to keep the current customers and sort of, accelerate that goodwill. It may be that if you're able to take a stance of increasing people's access to mental health services, that's your opportunity to create a competitive advantage. However you do that, I don't know what that looks like in your business, what you're allowed to do, but I wish you the absolute best of luck. And if there's anything that I can do, please let me know. But I think that you may be in a situation where people are going to be looking at you for leadership if that's the case. I hope that was helpful. Thank you, Nick. I got 7 minutes. Anybody got anything else? Oh, there's stuff down here. Will the webinar be available for us to share with others on our team later? Yes. This is being recorded and I will post the recording. Nick, you're very, very welcome. Michael, does the nominal LTV to CAC ratio for a business change during a recession? Can you elaborate? So the same places on that spectrum, and I can go back and if you're going to be in the right place, we always want you to be in here. And it doesn't matter if times are good, times are bad. It's one of those things where when times are good, you want to be here to take advantage of it and grow at the optimal rate. When times are bad, you need to be here so that they don't get worse. And so we don't change the recommendation in terms of that ratio. We think that 5-to-1 is a really great spot to be for companies in a variety of conditions. Obviously, there are some times that hey, we really need to be up here. There are times that we need to be further in here, but if we're looking at what general kind of range of things that we look at as being, the growth spot, I personally don't move that goalpost. Hopefully that was helpful. And you are welcome. No? We got anything else? I'm here 5 more minutes, and not a lot to do. But this was cool. I'm gonna work on the Zoom issues, and next time we'll be able to do. I'm sure that next time we'll be able to do the live feedback and have people with their cameras on and stuff like that. But I really appreciate you guys showing up. It's cool to be able to do this stuff and connect with you in this way, even though for me, very much feels like I'm just yelling at my computer screen. But I definitely appreciate you guys. You are welcome, Nick. Thank you for coming. Oh, and I just figured out how to allow people to talk. Look at that. Um, well, cool, guys. I really appreciate it. This was cool for me too, and I really hope that I don't know, people learned something. That would be all right. Well, I've got 11:58 on my clock. If there are any final questions or thoughts, feel free to pop them in. Otherwise, I'm going to shut this down. I'm going to make the recording available, and I really appreciate you guys for coming. Thank you so much.